So our recording is on. Today is Monday, March 28th. This is the 12:30 section. Welcome back from spring break. Today we'll mark the next section of this class, which is the valuation part of this class. And we are going to start building a reusable valuation model. So what you're going to need to do over the next several classes in building a reusable evaluation model yourself, because I'm not going to give you one, you're going to actually build it, is we're going to start with these two files. So on Elms, there's a folder in the files folder under Nokia with the two files, and the two files that you're going to need are called Nokia Data and Valuation Model Starting File.xlsx. So I'll need you to download and open those two files. So while you're doing that, as I said, we're going to be building those files, starting with that. So you're going to copy everything that I do in class over the next week. And where we end up at the end of Wednesday's class is your next homework assignment. So if you're able to do everything we do in class, then you've completed your homework assignments in class this week. If you haven't done everything we've done in class, then you'll need to watch the videos and submit that file next Monday as your next graded homework assignment. So while you're getting those two files downloaded and opened, I'm going to also quickly check on the Bloomberg Trading Challenge, which is started for the second half of the semester. So looking at the Trading Challenge, this is section 401. Second half, there we go. So there should be six teams. There are 6 teams here, which is great. Everybody should have less than $300,000 worth of cash. A couple teams closing right at the edge there, but everybody is meeting that standard. By the end of the first half, remember you got to have at least 10 more longs. So we still got 2 teams that need to do a couple more trades, but you got about 5 weeks to do that. So you're okay. Again, shorts don't count. And if we score you today, we can actually see that the team in first place actually has a 6% return over the last 11 days, which is pretty good. Obviously, the market, the first half of the semester was pretty tough. So far, it looks like the beginning of this semester has been a little bit better, but nonetheless, this is the performance as of today. Okay? And so again, hopefully everybody's doing what they need to do for the trading competition. If you have any questions, let me know, but that was just a kind of quick peek to see where we are at the start. All right, so as I said, you should have 2 files that you have downloaded. The first one is this one called Nokia Data, okay? And what this represents is historical income statement, balance sheet, and cash flow information for Nokia for 6 historical years. Okay? So one of the things that we have realized, somebody asked in the chat about midterms. TAs will post the midterm grades. They're the ones grading the midterm. One of the things we realized is that as we tried to build reusable valuation models, we need standardized financial statements to do that. So every company is going to use the same model. Bloomberg, believe it or not, doesn't have standardized statements. We have looked at their standardized statements in the past, and as we've gone from company to company, we've noticed they change. So by definition, that means it's not really a standardized statement. So we've had to create our own standardized statements in this class to build a reusable model. So in order to build the reusable model with standardized statements using real world data, we're still using Bloomberg as our data source. And so we're going to be exporting from Bloomberg raw data. This is the raw data coming from Bloomberg. And later, I will show you how you will be exporting data from Bloomberg. Okay, so that's the first file, Nokia Data. Okay, now the second file that we are going to work on in Excel is the start file. So that's the one called Valuation Model Nokia Start.xlsx. Sorry, just opening that myself. Starting file, which is this file, which I will share. And you'll notice that the valuation model starting file has a series of tabs which go from left to right. And the first tab is called the model data. That's the data that was on that previous sheet. Okay, this is the raw data coming in from Bloomberg, income statement, balance sheet, cash flow for the last 6 years. Okay, revenue, cost of revenue, interest expense, minority interest payments, etc. Okay, now what I've done, and again, series of tabs, I'll start out with the income tab, is I've created a standardized income statement using the 6 years of historical data. And again, this is Nokia, okay? But it could be any company. Again, just as we export different companies from Bloomberg, we're just happening to start with Nokia. So there's 6 years of historical data. I've already done that, right? I also have a tab called the balance sheet where we have the 6 years of data to create 6 years of historical balance sheets, again, in a standardized format, okay? Now, the next thing I've done is take this balance sheet and I've mapped it to this tab called TFI. There are 6 years of converted and balancing TFIs. I'm sure you would have appreciated this on your midterm exam. Okay? The next tab is called TII, which is mapped to the income statement, which is 6 years of converted and balanced TIIs. Okay? With 6 years of TII and 6 years of TFI, we then have 6 years of historical balancing CFI, which are mapped to these statements. And then the final tab is the economic profit tab, 6 years of historical balancing economic profits. Okay, so model data creates historical income statements and balance sheets, which creates the historical economic statements that balance. I've already given you that rather than starting from complete scratch. The final tab over here on the right is called ROIC drivers. This is the tree. So the model will automatically build the tree for you for the last 5 years. Okay. So those are the historical data. Now over here on the left, there's a tab called ratios. Ratios are just that, historical income statement and balance sheet ratios. All of these ratios for the last 6 years are a percentage of sales, except for the revenue growth rate, which is the percentage change in sales, right? So these are the historical ratios, income statement and balance sheet, that come from the historical income statement and balance sheet, okay? The final tab in the model is called the assumptions tab. Now, this is where we get into our forecast, which is what we're about to start to do, okay? So we are going to create a forecast income statement and balance sheet. We'll create forecast economic statements and statements of cash flow, which will then create an enterprise DCF valuation. And that's where we're about to go with this spreadsheet. And that's what we're going to start to build. Now, when we build the forecast, we're going to start making some assumptions. Some of the assumptions that we're going to start to make are outlined here on this tab. You'll also notice that I'm using a color yellow, right? And I'm using this color yellow intentionally because we're going to build a reusable model. And when we build the model, some cells, for example, go to the income statement, you'll see that gross profit over here is G3 minus G4. So I don't want to accidentally overwrite this cell because it's going to break the model. Okay, so how do I know what I can actually change in the model? And how do I know what I can change in the model? Because I want to break my reusable model. That's where the cells that are yellow come in. So yellow cells are going to intentionally be cells that I know that I can change in my reusable model so that when I reuse Nokia for somebody else, I don't break the model, right? Second reason I'm doing it this way is, again, a better practice that McKinsey talks about is you want to limit where the assumptions are in your spreadsheet. Because if you scatter these assumptions throughout your entire spreadsheet, I guarantee you at some point, you'll forget to change an assumption that's buried on one of these tabs when you reuse the model. And it will frustrate you because you're like, my model doesn't make sense and I don't know why. And the reason is because you forgot to change an assumption that you'd use for Nokia when you reuse the Nokia model for some other company. So in order to mitigate against that, we want to put the assumptions in as few places as possible in our model that we're going to reuse. And so in our model, they're going to be on two tabs, the assumptions tab and the ratios tab. Those are the only two places that we are going to put reusable assumptions in our model. And the way that I'm going to distinguish the assumptions between these two tabs is the assumptions tab are universal, meaning one assumption goes across all years. When we put assumptions into the ratios tab, these will be year by year assumptions that could change in any given year. As a matter of fact, that's actually where we're about to start in our forecast valuation for Nokia. Okay. So at this point, you should all have your file ready to go. You're now ready to essentially do what I do and start copying what I type in. Okay. So building the model, we're going to start forecasting 2022. So cell H1 will be our first year of our forecast. We're going to label it as such. For a reusable model, we want 2022 to be a relative year. So for H2 equals G2 plus 1, I want to hard code the year. I want to make it a relative year to the past years. And the first ratio that we are going to forecast is the revenue growth rate. So for cell H3 equals G3 as a placeholder. Nokia's 2022 growth rate will basically be the same growth rate as 2021 to start. And I'm going to make that cell yellow to highlight to me that this is something that I could change. Okay. Now let me show you how this is going to work in practice. So we're now going to go to the income tab. Same thing. We're now going to start creating our forecast. So type that in cell H1. For cell H2 equals previous year plus 1. So equals G2 plus 1. So the first year is 2022, a forecast. Now I'm going to put in the forecast for 2022 revenue. So how do I do that? So cell H3 equals cell G3 times left parentheses 1 plus the revenue growth rate, which is ratios H3, right parentheses. Enter. So if Nokia were to grow by 1.6% in 2022, it would grow to 22,557.6 million euros in revenue. Now, just to have the formatting consistent, I'm going to select here from H3 all the way down to H27, formatting, comma, 1 decimal place to match everything before. Right? So again, the ratio creates the income statement forecast. So for example, if Nokia were to grow 4% in 2022, type in 4%, then on the income tab, 23,090.1. If Nokia were to shrink by 2%, income tab, 21,758. Ratio creates forecast. Now, just so we have the same numbers for our homework assignment, building the same model, I'm going to undo that, and I'm going to leave for 2022 the placeholder equal the previous year, equal G3. That's what you should have. Okay. Now, Following that process, we're going to build the rest of the 2022 income statement. So let's go back to ratios. So the next ratio we're going to forecast, and you can see over here, the most important income statement ratios are in light gray, right? Because those three light gray ratios are the most important thing to forecast gross cash flow, which is the biggest impact of free cash flow. Okay, so those are going to be the most important income statement drivers. So I want to forecast EBITDA next, because that's the next big important one. So for cell H7 equals G7. And again, I'm going to make that yellow, 14.4%. Okay. So this is the forecast for EBITDA as a percentage of sales in 2022. Again, just repeating 2021 for right now. Now, in order to forecast EBITDA, I needed to actually forecast cost of revenue and operating expenses. This is my direct cost, cost of goods sold. This is my indirect cost at my SG&A. Subtract these two from revenue, I get EBITDA, right? Now, for simplicity, we're going to directly forecast EBITDA in the model, right? We're not going to forecast these two individually. We're going to skip that step, right? Now, if this were the real world, you're working at like Goldman Sachs or somebody, companies would actually care that you had forecasted the cost of revenue and operating expenses separately to get to an EBITDA. But since our model doesn't care and it just wants the EBITDA, we're going to make it a little bit easier and this semester forecast EBITDA directly. 14.4%, skipping the previous two. Next, we're going to forecast depreciation and amortization as a percentage of sales equals H8 equals G8. Again, that's something we're going to be yellow cell because we're going to change, which leads to our operating income. Operating income we're going to solve for. Operating income equals, so H9, EBITDA, which is H7, minus depreciation, which is H8, is 9.5%. Now that cell is not going to be yellow because it's a formula based on the two items above. Right, so operating income, 9.5%. Tax rate for 2022 equals the previous year. Again, as a placeholder, we're going to say the tax rate is the same as it was last year. We're going to change it later to be more realistic, but for now, 14.3%. And we're going to make that yellow because that is something that we're going to change. Operating income after tax is no plat. So we're going to solve for no plat. No plat equals operating income, H9, times left parentheses, 1 minus the tax rate, H10, right parentheses, parentheses, 1 decimal place, 8.2%. Okay. Now, if you had trouble with that formula, you can look in cell G11. I've already put in the formula for last year. You can copy G11 over to H11. Non-operating gains and losses equals the previous year. That is something that could change, so we'll make it yellow. So we have 5 ratios that we are going to forecast that will drive our income statement, which lead to these 2 other formulas. Once you've gotten to this point, take column H, select it, copy it, go to column M, paste it, and that will create forecasted ratios through 2027. Now, for purposes of this class, again, we're going to use arbitrarily 6 years worth of forecast. And what that will represent is 5 individual years that we will forecast year by year. And year 6 is what's called the N+1 or T+1 year, which is the beginning of the perpetuity period. So this is where perpetuity starts. And these are the individual years that we're forecasting before perpetuity. So we're building a 6-year valuation model. That's arbitrary. You might do a 10-year model in the future. You might do a 3-year model. The point is you want to go enough years so that whatever company you're valuing becomes stable / mature. Okay. For Nokia, you can see that they're already looking pretty mature. So we probably didn't even need to go out 5 years before we did a perpetuity period. If I were doing another company that was in still hyper growth mode, I might have to go a number of years before a company like, for example, Tesla is a mature company. So I might go well beyond 5 years, right? So I need to understand how long my company needs to be valued year by year before I go perpetuity. But for this class, for simplicity, we're just going to arbitrarily say 6 years. Okay? So 2022 to 2027 is our forecasted income statement period. Using those ratios, we're now going to go to the income tab and finishing reporting out Nokia's actual income statements. So again, starting with EBITDA, okay? 2022 EBITDA for Nokia equals, so this is cell H8 off the income tab, equals from the ratios tab, H7, which is 2022 EBITDA as a percentage of sales, times income 2022 revenue. Return 3259.4. So that would be Nokia's EBITDA in 2022 if that ratio came true, 3259.4 million euros. Same process for depreciation. So depreciation amortization in 2022, which is cell H9, equals ratios H8, which is depreciation and amortization as a percentage of sales, times income H3, gets us 1,112.5 million of depreciation. Solve for operating income equals EBITDA H8 minus depreciation H9, 2146.8 million of operating income. In a very short period of time, we have forecasted Nokia's revenue, EBITDA, and operating income for 2022. And the number that you should have in your Excel file should be 2146.8 for operating income. Questions?
Yeah, can you repeat how you got the formula for EBITDA forecast?
So EBITDA for 2022 equals ratios H7, which is EBITDA as a percentage of sales, times income H3, which is 2022 sales, 2022 revenue. And that's going to get you your 3259.4. Same process for depreciation. Ratios times forecast equals the amount. It's basically the process that we're following here. Other questions? All right. Now that we have forecasted operating income, we need to get down to pre-tax income. Next kind of key driver here, which means we need these 5 items to create our pre-tax income. The first one is the interest expense. So here's the assumption. Again, from the readings in the book, we are going to use a target capital structure when we do an enterprise DCF because we use a constant WACC, right? So a constant WACC implies a constant capital structure. And to oversimplify, we're going to say that the current capital structure equals the target capital structure. Said a different way, whatever debt and equity the company has, we're going to leave alone, okay? Their current debt stays, their current equity stays. We're not going to change it, which means if the current debt stays, the current interest expense should essentially stay. So we're not going to really change the interest expense in our model. We're just going to say equals the previous year. Now, you'll quickly realize as we build this model that the debt and equity don't affect the valuation. They're separate than the operating, the non-operating cash flows. So they have zero impact on the valuation. But I like to call it almost like window dressing, but we still have to have a forecasted income statement. So we do have to go through the motions of forecasting the statement. If for some reason you think you want to come up with a different forecast than the assumptions that I made, turn your cell yellow, put in a forecast that you think could be better. But I'm also telling you It's not going to affect the valuation. So I'm trying to keep this a little bit easier. Okay. Same thing with interest income. Just like interest expense, if we're not changing the capital structure, leave that alone, equals the previous year. Equals 28 million. So equals G12. FX gains or losses, 0. I don't know what the currency is going to do in the future. Neither do you. So I don't know whether the currencies are going to have good or bad impacts on a company's FX gains and losses. So therefore, we're not going to forecast them. We're going to put them at 0. And we're going to assume most companies will try and hedge. They'll try and keep it fairly neutral. And even so, we don't know what the impacts are going to be because we don't know which way the currencies are going to go. So therefore, 0. Right? If again, you think you can come up with a forecast, you think it's material, you can always change it. Make it yellow and change it. But again, won't affect our valuations. Income loss from affiliates equal the previous year. So H14 equals G14. Again, whatever incomes or loss they're having, we're going to leave that alone. And the final item here is non-operating gains or losses. That was a ratio. So for cell H15 equals, from the ratios tab, non-operating gains and losses as a percentage of sales, H12 times income, H3. 53.8 million non-operating gains and losses. So operating income minus interest plus interest minus equals pre-tax income. Okay. Now for simplicity, if you go to cell G16, you'll see I've already done that. I've already put in the right pluses and minuses based on everything on the left. So just to be lazy, we're going to take cell G16, we're going to copy it, we're going to go to cell H16, we're going to paste it, and we will get the right pre-tax income of $1,953,000,000. Now, assuming you got that income, we have to say, okay, on 1,953,000,000 euros of income, we'd have to pay tax. Well, our tax rate is 14.4%, 14.3%. Okay. So here's what we're going to do. We're going to say for taxes paid in 2022 equals the pre-tax income, 816, times from the ratios, 2022 tax rate, 278.9. So if we have 1953 of pre-tax, we pay out 278.9 in tax. Income before extraordinary items is H16 minus H17, 1674.1 income before extraordinary items. The next line down is the extraordinary loss net of tax. In H20, that is 0. By definition, an extraordinary item should be just that. It's extraordinary. It's non-recurring. Shouldn't happen again. Okay. So I don't know what extraordinary items are in the future because they're extraordinary. We don't know what they are. So therefore, 0. Now it's ironic that Nokia has had extraordinary items every single year for the last 6 years. That starts to look suspicious because if extraordinary items are supposed to recur and you seem to have them every year, are they really extraordinary items or are they really just a normal part of your business, right? That would be an interesting question to look at for Nokia. But for right now, we're not going to forecast extraordinary items in the future, even though they seem to have one every year. So 0. Minority interest, or sorry, net income before minority interest is equals H18 minus H19. So it should also be 1674.1. Now we get down to the minority payments to the minority shareholders. So last year they paid 22 million in dividends to the minority shareholders. Again, we are going to leave a target capital structure, which means we're going to leave the debt and equity alone, which also means we're going to leave the dividend payments alone. Whatever dividends you're paying, you keep paying. We don't change those. So the 22 million of dividend payments to the minority shareholders, that recurs in 2022. So H21 equals G21. And net income equals the net income before the minority interest, 1674.1, minus the minority interest of 22, gives me a total net income forecast of 1652.1. So very quickly, we have forecasted a Nokia income statement for 2022 based on those ratios of 1,652.1 million euros. We could now do a TII. However, what we're also going to do is we're going to forecast down to what we're going to call change in retained earnings, because eventually we're going to need to know how the balance sheet changes in 2022 based on what's happening with the income statement. And so the retained earnings in the balance sheet formula for retained earnings is net income minus dividends is how much the retained earnings change. So that's what we're about to do. We're going to subtract off the dividends. We're now X income statement, we're beyond the income statement, to get to this notion of a change in retained earnings. So there are two types of dividends we're going to forecast, preferred and common. So the first one is the total cash preferred dividends in 2022 equals the previous year. So G23 equals G23 for H23, not zero. Now, Nokia is not paying any preferred dividends right now, but since this is going to be a reusable model, another company might be. So again, equals previous year for cash dividends. Other adjustments to equity, zero. So these are adjustments that companies will make based on changes in FASB or IFRS rules on changes to their accounting statements in the future. These typically are non-cash items, and they're just paper adjustments. And we also don't know what they're going to be in the future. So therefore, we're not going to forecast them for Nokia. Again, just like I said with extraordinary items, if you know it's going to be something and you think it's material and you want to put it in here, you can always make it yellow and throw it in. But for purposes of our valuations, that won't matter. So I'm going to leave that as zero. That gets me to a net income available to common shareholders. I want you to take cell G25, copy it, go to cell H25, paste it. So I get net income to common shareholders of 1652.1. I then see that they paid 9 million in dividends in 2021. Again, since we're not mucking around with the capital structure, for H26 equals G26. 9 million of dividends in 2022. That leads to a change in retained earnings. Now, here's a little bit of a quirk. The formula for change in retained earnings is income minus dividends. However, dividends are a negative number. So if I do income minus a negative number, it'll be a double negative, which will essentially add it and give me the wrong answer. So even though the formula is income minus dividends, because dividends is coming in as a negative number for change in retained earnings, equals net income, which is H25, plus the negative dividend, H26, 1643.1, right? And you might say, confused, why is this number negative? Why am I adding the negative? And this is because of our data feed. Started the class by telling you we're taking a raw data feed from Bloomberg, income statement, balance sheet, cash flow. On the income statement, revenue is coming from Bloomberg, positive number. Cost of revenue coming from Bloomberg, positive number. Operating expenses coming from Bloomberg, positive number. Interest expense, positive number. Interest income, positive number. So when we built the income statement, it's revenue minus this, minus this, minus this, plus this, etc. Okay. However, when I pulled data from the cash flow statement on Bloomberg, dividends paid are a negative number. So in the income statement, they got expenses are positive numbers. On the cash flow statement, dividends are negative numbers. Formatting, it's your data source. So because I know dividends are coming from as a negative number, not a positive number, I know, and this is just an important valuation technique, if I'm going to tie to a reusable data source, I have to add the negative because I know it's coming to me as a negative number. Okay. By the way, I also know that preferred dividends are going to come as a negative number. Okay. So the reason I told you to copy row 25 over is because if you look at the formula, it's net income plus the preferred dividends minus the other adjustments, because I know G23 is going to be a negative number. Okay, so I've accounted for dividends being negative in solving for my change of retained earnings, and this is the number you should get, 1643.1. Questions about any of that?
So if the number what ended up being negative for or positive for dividends paid, we would subtract it.
Exactly right. Yeah. So there's two things going on here. One, we kind of have to do the conceptual, let's get this right. Two, we have to be sensitive to the data source that we're pulling the data from. And like I said, Bloomberg, and this is what professionals use, gives you data in slightly different formats. And if you aren't paying attention to the data that's coming from your data source, it could cause problems with your model. But absolutely. So if it came through as a positive number and they changed it, we'd have to subtract it. And if Bloomberg ever made that change, it would cause chaos throughout Wall Street. Because for the last 30 years, dividends have always come through as a negative number in people's models. Okay, so column H, now that we have the income statement, select the income statement, copy it, go to column M, right-click, paste. I now have forecasted income statements for Nokia going through 2027. And then I will go to my TII. These are the TIIs that are mapped to that income statement. Take column G, copy it, go to column H, paste it. I now have a forecasted TII, which is balanced for 2022. This is now a forecast. So I'll flip this to remind myself. And then I'll take column H, select it, copy it, go to column M, paste it. I now have forecasted statements for Nokia of TII going through 2027. So in a little over 30 minutes, we have taken Nokia's financial statements and we have created 6 years of forecasted income statements and 6 years worth of forecasted economic TII. So this is the number you need, 1974.2. Your model should match this exactly. Next, we're going to do the balance sheet. But again, before I go to the balance sheet, questions about any of this. You should be matching this. Somebody said this is based on the constant ratios for 6 years. Absolutely. That's how I know we should all have the same model, because we are using constant ratios for the next 6 years, which repeat 2021. Okay, so if 2021 kept repeating itself, this is what their statements would look like over 6 years. Okay, again, as we build the model, we're going to use the constant ratios. Next week, when we actually value Nokia to their real share price, we will adjust to be more realistic with these ratios. But while we're building it, I need you to match what I do. Therefore, we're using these constant ratios. All right. Now we're back in the ratios tab. We're going to start forecasting the balance sheet. Same thing. Every one of these balance sheet items is a percentage of sales. So for 2022, accounts and notes receivable, H14, equals G14. And that is going to be a cell, which I'm going to make yellow, because again, that could change. So then I'm going to take cell H14 and I'm going to copy it. I'm going to select all the way down to M23 and I'm going to paste it. Okay. So this is just saying repeat equal the previous year all the way through column M, which is 2027 for all these ratios. The one ratio we're not going to repeat for equal in the previous year is invested capital to sales. Invested capital to sales on this tab is the same invested capital to sales as on the ROIC drivers. That's this IC to sales. The only difference is this is historical data. And here on the ratios tab, this is going to be the forecast invested capital to sales. So I'm going to take G24, copy that, highlight, paste, and make that going forward H through M, not yellow. Okay. So right now it's blank, 0, because we don't have a forecasted balance sheet, which means we don't have forecasted invested capital. We're building that. A little while, that's actually going to be filled in with real numbers. And this is going to be our check in our valuation that we have a reasonable forecast of the balance sheet, the forecast of invested capital to sales over time. Okay. So that's what this final number is going to be. It's not yellow. Now, continuing on with these forecasted ratios, we're going to go to the balance sheet tab and we're going to start creating a 2022 balance sheet. So cell H1 is the first year of my forecast. I will label that as such. First year is 2022. So for H2 equals previous year plus 1, relative year. And the first item that we're going to forecast in the ratios is accounts and notes receivable for 2022. So for 2022, accounts and notes receivable, it's going to be right here. So row 6. So basically equals from the ratios, 24.2%, which is H14 on the ratios tab, times from the income tab of 2022 revenue, which is H3, 2255.57.6. Hit enter, 5468.2 of million euros of accounts and notes receivable. Now again, I'm going to select all of this to format it, comma, 1 decimal place just to match. So again, that's my forecast for accounts and notes receivable, assuming that ratio holds true. Okay. Do the same process 10 more times. So the next one is unbilled revenue. So in 2022, unbilled revenue equals, from the ratios tab, 2022 unbilled revenue as a percentage of sales, H15, times from the income tab, 2022 revenue, which is H3. That gets me 1164.4 million euros of unbilled revenue. Again, next one, inventory equals for 2022 from the ratios tab. 2022 inventory as a percentage of sales, H16, times from the income tab, 2022 revenue, 22,557.6, H3. That's going to give me 2430.3 of inventory. Same process for other current assets, equals from the ratios tab. Other current assets as a percentage of sales, H17 off the ratios, times income H3, 2022 revenue, gets me 1,090.2 of other current assets. The next ratio is long-term investments, equals from the ratios tab. Long-term investments as a percentage of sales is H18 times income H3, gets me 1,100.3 of long-term investments. Net fixed assets equals from the ratios tab, H19 times from the income tab, 2022 revenue, H3. That gets me 2853 of net fixed assets. Skipping goodwill, the next one will be other long-term assets, equals from the ratios tab, H20 times income, H3, 9,662.3 million of other long-term assets. You can notice Nokia has a big portion of their balance sheet and other long-term assets. The next ratio is accounts payable, equals as a percentage of sales. H21, 34.5% of sales is accounts payable times income H3. That works out to be 7,788.8 million of accounts payable. Other short-term liabilities equals ratios H22 times income H3, 4,202 of other short-term liabilities. And finally, other long-term liabilities equals ratios H23 times income H3, 1798.3 of other long-term liabilities. So basically, we've just taken those 11 ratios and we've created 11 different forecast balance sheet items for 2022. Now, assuming that you've gotten all of these numbers correct and all the numbers in, our next step is to finish the balance sheet so that it balances and most importantly, does not have a circular reference. A circular reference is an invalid model. In this class, it won't be graded and you won't get any credit for turning in an invalid model. So not only must you turn in balancing statements, you can't have a circular reference. I'm going to show you how to create the forecast without having a circular reference. Now, to do that, we're going to finish off the liabilities and equity side of the balance sheet first. And specifically, we're going to forecast equity first. These 4 equity accounts. Starting out with total preferred equity, row 28. So for H28 equals G28. And the reason why is going back to if we are operating with a target capital structure and we're not changing the debtor equity in the firm in the future, whatever equity they have, they keep. So any preferred shares they have, they keep. They don't issue new ones. They don't repay it, old ones. Equals G28. The same is true with the minority interest stakes. Whatever minority interest stake they have exists, so equals G29. They don't change it. They don't increase it. They don't decrease it. Same thing with share capital. They don't issue or repurchase shares of stock. So share capital and APIC, which stands for additional paid-in capital, equals the previous year, equals G30. The one thing that will change is retained earnings, because we know that retained earnings goes up based on the profitability of the income statement. On the income statement, we figured out how much retained earnings are going to go up. That was this row. It's net income minus the dividends. That's how much retained earnings should go up. So back to the balance sheet. For 2022, retained earnings equals 2021 retained earnings, G31, plus from the income tab, the 2022 change in the retained earnings. Income H27, which is the income minus the dividends. So therefore, retained earnings should grow to 18,303.1. If I sum in H32, the 4 items above from H28 all the way down to H31, that would be my total equity, 19,105.1. Just as I forecasted the equity, we're now going to forecast the debt. Short-term borrowings is interest-bearing debt. Again, we're not changing the capital structure. Whatever debt you have, you keep. So last year they had 301 million of short-term borrowings. Same for 2022. Equals for G20, or sorry, H20 equals G20. 301. Long-term borrowings, same premise. Whatever long-term debt they have, they keep. So H 23 equals G23. Pension liabilities. Whatever you owe to the employees, you still owe, equals previous year, equals G25. Any new pension liabilities we assume to be NPV 0. Plus, they're not expected to grow anyways. You're not allowed to. The regulators won't let you. And you still owe the previous ones, 3408. Now, I'm ready to sum my current liabilities. Current liabilities are the three above: accounts payable, short-term borrowings, and other short-term liabilities. So for cell H22 equals the sum H19 to H21, be 12,290. For long-term liabilities, that would be the sum of the three above: long-term borrowings, other long-term liabilities, and pension, H23 to H25. For total liabilities, it's my current liabilities, H22, plus my long-term liabilities, H26, 22,804.3. And my total liabilities and equity equals H27 plus H32, 41,909.5. So that is the forecast in 2022 for the liabilities and equity of the balance sheet. I said it's very important that we get the balance sheet to balance. So it means our assets have to be 41,909.5. So I'm going to show you the trick. Take H16, which is total assets, equals H33. There you go. Our balance sheet balances. And it will always stay in balance because we're forcing it to. And you might say that was easy. So here's the point. In order to keep the balance sheet in balance, to get these two sides to really match, all of these assets have to add up to 41,909.5. The way that we're going to do that is we're going to make one of these what's called a plug, right? So we're going to solve for one of these that actually makes them all add up to 41,909.5. The plug is excess cash. So in our model, we're going to solve for excess cash once we forecast the rest of the assets, which means we have two more assets that we have to forecast: operating cash and goodwill. Somebody asked in the chat, can you explain how you got H31 again? Sure. So for H31, which is retained earnings, it is last year's retained earnings, starting retained earnings, G31, plus this year's change in retained earnings, which is from the income tab, H27. Okay, because we know that income minus dividends is change in retained earnings. That's H27 in the income statement. Add that to last year's retained earnings. That's this year's retained earnings. 18,303.1. All right, so back to the assets. Since we're plugging for excess cash, we need to solve, or we need an assumption for operating cash, and we need an assumption for goodwill. So let's start out with operating cash. Operating cash, H4, equals, from the assumptions tab, operating cash as a percentage of revenue. That's B3. Times, from the income tab, 2022 revenue, H3. That's going to equal 451.2 million. Now, as a reminder, you might say, gee, we've been using the ratios tab all this time. Why did we jump to the assumptions tab to do operating cash? Why isn't operating cash on the ratios tab? Again, the reason is anything on the assumptions tab does not change year by year. The assumptions stay constant across all of the model. Everything on the ratios tab, we can change year by year. Okay. The assumption on operating cash is a company needs a minimum amount of cash, otherwise it's not going to be able to function. So that minimum amount of cash is going to be universal. All right. So that's why I put it on the assumptions tab versus the ratios tab. And the idea is I put 2% as a placeholder. Now, 2% is 1/50th of the year, which basically means 1 week of cash. And I'm saying any company that goes below a week of cash is not going to be able to function. Now, we could change that, right? That's why it's yellow. I just put in this as a placeholder. So again, Nokia 2% of sales represents 451.2 million. That's the minimum operating cash. In fact, if you look at that formula, it's assumptions B3 times income H3. I also need you to edit this formula and make one additional change. I need you to take B3 and put a $ in front of the B and a $ in front of the 3. That's going to tell Excel to make assumptions B3, which is operating cash as a percentage of revenue, an absolute reference. So that when we copy and paste this, it will always refer to cell B3. Because if I copy and paste it and it goes C3, D3, E3, there is no C3, D3, E3 on the assumptions tab. So we got to make it an absolute reference to cell B3, $B, $3. Finally, goodwill. Last year, they had 7,051 million in goodwill for cell H13 equals G13. We're going to leave the goodwill alone. 2 reasons. 1, I don't know what Nokia's acquisitions are going to be in the future. Neither do you. Neither probably does Nokia, much less what they're going to pay for them and how much goodwill is going to come up from them. So therefore, we're not going to forecast it because we don't know. And most acquisitions would be M&A MPV 0. So therefore, I'm not going to worry about acquisitions, right? And if I think about historical goodwill, we don't amortize goodwill. We impair goodwill, which means theoretically, goodwill stays on your balance sheet forever. Every year, the accountants look at it and say, is it worth what you originally paid? If not, they write it off. And when they write it off, it doesn't affect cash flow and it doesn't affect taxes. So it's really just a paper exercise, right? But nonetheless, it won't affect our valuations. So for historical goodwill, because it could theoretically stay on forever if it's not impaired, and even when it's impaired, it doesn't affect cash flow, we're just going to equal the previous year. And as I said, we're not going to forecast new acquisitions because even at best, we don't know what they're going to be. So therefore, how much goodwill that would be. So equals the previous year is the placeholder we're going to use. That gets us all of the assets that would add up to total assets, except for excess cash. And now we're ready to solve for or plug excess cash. So here's what we're going to do for cell H5. So equals total assets, which is H16, minus everything else, minus the operating cash, H4, minus accounts receivable, H6, minus unbilled revenue, H7, minus inventory, H8, minus other current assets, H9, minus long-term investments, H11, minus net fixed assets, H12, minus goodwill, H13, minus other long-term assets, H14, hit enter, 10,638.6 million of excess cash. And notice no circular reference. Okay. So now I'm going to sum my total current assets. So H10 equals the sum of everything above. So from operating cash all the way down to other current assets. So H4 to H9, 21,242.8 million. I'm going to sum my long-term assets from long-term investments all the way down to long-term assets. H11 to H14. I'm going to add my current assets to my long-term assets. And if I were checking, these two numbers are now equal. So with my plug, I equal my total assets. So take column H, select it, copy it, go over to column M, right click, paste. I now have 6 years worth of forecasted balancing balance sheets going through 2027. I then go to my TFI. Now that I have balancing balance sheets, I can forecast the TFIs for those balancing balance sheets. Take column G, which is mapped to my balance sheet, copy it, go to column H, right click, paste. This is now a forecast. Change the label in cell H1. Take column H, copy it, go to column M, paste it. I now have 6 years worth of forecasted TFIs that also balance for Nokia through 2027. Now that I have 6 years worth of TIIs and 6 years worth of TFIs, I can create my CFI forecast for Nokia going through 2027. So I'll take column G, I'll select it, I'll copy it, go to column H, I'll paste it. I'll say to myself that this is my forecast. So I'll write that in cell H1. I'll take column H, I'll copy it. I'll go to column M, I'll paste it. I now have 6 years worth of forecasted and balancing CFIs for Nokia. And finally, economic profit. Take column G, copy it, go to column H, paste it, flip the history to forecast again for labeling purposes. Take column H, copy it, go to column M, paste it, and I now have 6 years worth of forecasted economic profits, which balance for Nokia. Okay. So in a little less than an hour, we have created 6 years worth of income statement ratios, which have created 6 years, and balance sheet ratios, which have created 6 years worth of income statements and balance sheets, which have created 6 years worth of economic statements of TFI, TII, CFI, and economic profit. And you'll also notice in the ratios that these ratios of invested capital to sales are now filled in, because by filling out the balance sheet, we've created invested capital and it's created that ratio for the future. This is where we're about to pause today with what I'll call part 1 of your model. So you need to save this. So I'm going to save this. As part 1 on section 401 today. And this is where we're going to pick up in our next class. I'm not giving you this file. So you individually cannot share this file with anybody else. That's an honor code violation. You have to create this yourself. So you need to match everything that we have done through today. We're going to pick up at this exact point on Wednesday. And you're going to create the rest of the file, which is we're going to take this, we're going to turn this into an enterprise DCF valuation of Nokia. Where we end up in class on Wednesday is what you're going to turn in for your next graded homework assignment. I'm not going to give you a solution to that file on Monday. You're going to take that file and you're going to make additional changes, because you're going to use the file that you were creating to do all future homework assignments, and more importantly, your group project. If you don't create this file, you won't be able to do those assignments, and bad things are going to happen to your grade. So this is something you're going to have to do yourself. So again, we're pausing. This is all we're going to get to in class today. Before I let everybody go, is there anything you want to look at? Okay, because in order to match, I'll be real simple. You should have in your CFI 182.7. If you don't have 182.7 for your ending CFI in 2027, you got a flaw in your model somewhere. Okay, because everybody should have that number for your CFI. It's really easy for the TAs to grade it. They can just open up your model, go right to the CFI. Do you have that right CFI? Do you have all the other tabs filled in? Okay, but you should be matching. You should be matching that in the income tab, your final income, change of retained earnings, 1791.5. Your final balance sheet should be 51,705.7. Your final TFI should be 36,778.2. Your final TII should be 1974.2. Your final CFI should be 182.7 and EP should be 1197.6. Like that's what you should have. If you don't have it, is there anything you want to look at? I'm happy to answer a question, show you a cell. Otherwise, we're done with class for today, and this is where we're going to pick up on Wednesday. So before we adjourn, does anybody want to look at anything or get any further explanation? Which values again? So we said in the text, they want to see the values, all of them. All right, so here's income. These are what you need to get to, 1791.5 in the last year. Here's the balance sheet, 51,705.7 in the last year. Here's TFI, 36,778.2 in the last year. TII, 1974.2. CFI is 182.7. And economic profit is 1197.6. Somebody else asked in the chat, why don't we forecast gross profit? Okay. So going back to the income tab, I'm skipping these for a shortcut because what the model really cares about is EBITDA. Okay. And we can forecast these to get to an EBITDA. As a matter of fact, these are the components of EBITDA, right? I'm just trying to save you guys a little bit of time and effort because these two have to be in sync, operating expenses and cost of revenue to get to EBITDA, just adds a complication. So for this class alone, I'm simplifying by letting you directly forecast EBITDA and skipping this step. So that's just a choice I'm making. If you want to be more granular and forecast these, have at it. Just make sure that revenue minus all this equals that. Other questions? All right, well, if no other questions, save where you are. And then essentially I will see everybody in class on Wednesday. Welcome back from spring break. Hopefully you had a safe and enjoyable spring break. And again, have a good day.